Hello everyone, welcome to my channel. Today we'll be having a very interesting discussion. So I want to start my video with a very important statement. So everyone thinks that in 2008 financial crisis was history. But what if I say that the same Jenga game is still being played in 2026? So I don't want to further delay. So I request you to please watch this clip. Then we'll have a clear discussion about this particular 2026 financial crisis.
Hi, how are you? Okay, Mr. Bennett, here we have.
Let's see what you got.
You smell that? What is that?
What?
What's that smell?
The cologne?
No.
Opportunity.
No. Money.
Okay.
I smell money.
Okay.
Chris.
Damn it. Sorry.
This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. The modern ones are different. They're private, and they're made up of layers of tranches. The highest level AAA is getting paid first. The lowest rated B is getting paid last, taking on defaults first. Now, obviously, if you're buying Bs, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. Where's the trash?
Behind you.
I'm talking rock bottom FICO scores. No income verification. Adjustable rates, dog shit. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close, is an opportunity.
Okay, you're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
You're completely sure of the math.
Look at him. That's my quant.
You're what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face.
That's pretty racist.
Look at his eyes. I'll give you a hint. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math.
Actually, my name's Jiang, and I do speak English. Jared likes to say I don't because he thinks it makes me seem more authentic. And I got second in that national math competition.
So you're offering us a chance to short this pile of blocks. How?
With something called a credit default swap. It's like insurance on the bond, and if it goes bust, you can make 10 to 1, even 20 to 1 return, and it's already slowly going bust.
10 to 1, 20 to 1. No way.
And no one's paying attention. No one is paying attention because the banks are too busy getting paid obscene fees to sell these bonds.
But wait, you are the bank. When you work for the bank, I bet your margins are pretty nice and fat.
Let's not talk about my margins, by the way. Being nice and fat, that's a nice shirt. Do they make it from End?
Aren't you the bank?
I work for the bank. I don't think like a bank. Big bank, small bank, I like to make money. All right? Let me put it this way. I'm standing in front of a burning house, and I'm offering you fire insurance on it. A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
So we try to understand this particular video from a modern perspective. See, normally you can't see the risk because there are several hidden elements or hidden factors. Now we try to understand this. So in 2008, the risk was visible, but unfortunately in 2026, the risk is hidden. So the modern risk is equal to high leverage plus interconnected systems. Now we try to understand why there is high leverage and what exactly this interconnected systems means. Normally in 2008, each block was a risky home loan. In this particular video, if you see, there were several blocks. So each block was a risky home loan. But when it comes to 2026, the blocks have changed. So the major blocks are buy now, pay later app loans, fintech lending apps, high leverage trading, and overvalued assets. So the modern risk is equal to high leverage plus interconnected financial systems. So here we took just an example that BNPLs nothing but buy now pay later, fintech lending apps, high leverage trading, and overvalued assets. So the system looks very strong, but risk is hidden beneath layers. So today everything is connected. So one failure spreads everywhere. If there is any one failure of the component of the system, then it spreads at a rapid pace everywhere. So if you see that today, as I mentioned, everything is connected means banks, fintech, stock markets, crypto markets, everything is connected. If any one sector fails, it spreads instantly. If there is any failure in banks, then definitely fintech will be affected, stock markets will be affected, crypto markets and nothing but cryptocurrencies is affected. So if any one sector fails, it completely spreads to the ecosystem. That's systematic 2.0 for you. Nothing but the systematic risk 2.0. So in modern context, the leverage is very, very dangerous. So if there is high leverage, a small stock or nothing but a small shock will have a massive collapse. So it means one trigger can crash everything. So we already seen these particular signals that there is crypto crashes, funding down, significant loan defaults. So not if, but definitely there is a possibility that there will be a crisis.